If you are married, own a business together, and you are filing just one Schedule C, you need to watch this. I see this mistake over and over again with married couples who are partners in a business. They have an LLC, they both work in the business. But when tax time comes, everything is filed on one Schedule C. That's not allowed. And by the end of this video, you will understand exactly how this should be filed and why it matters. First, let's take a step back and talk about what a Schedule C actually is. A Schedule C means that business is being reported directly on your personal tax return. There is no separate business tax return. That is your business profit and loss. It is commonly used for sole proprietors, single member LLCs, and in limited cases, married couples under specific IRS rules. This is where the confusion begins. This confusion usually comes from something called the qualified joint venture. Rules for married couples. Many people hear, if you are married, you do not need to file a partnership return. And while that can be true, it is only true in very specific situations. The problem is when these rules are applied too broadly or incorrectly. The IRS allows married couples to be treated as a qualified joint venture only if certain conditions are met. Both spouses materially participate, they jointly own and operate the business, and most importantly, there is no registered LLC or separate legal entity. In that specific case, the IRS allows the couple to avoid filing a partnership return. But here's the part most people and even some tax preparers miss. Even under the qualified joint venture rules, each spouse must report their share of income and expenses. That means 2 separate Schedule Cs, one for each spouse, not one combined Schedule C. Now, let's talk about where I see the biggest mistake. I've worked with many married couples who are partners in a registered LLC. Once you form an LLC with 2 owners, even if you are married, the IRS does not treat that as a qualified joint venture. At that point, the default tax treatment is a partnership. That means a separate partnership tax return is required. Filing everything on Schedule C in this situation is incorrect. This matters more than people realize. Filing the wrong form can lead to incorrect reporting of income, misallocated deductions, issues if the IRS ever audits your return, and unnecessary cleanup later. Most of the time, this isn't intentional. It's based on misunderstanding the rules. And this is also a message for tax professionals. If the qualified joint venture rules apply, 2 Schedule Cs must be filed, not one. If the couple registered an LLC, a business partnership return is required. Getting this wrong puts your clients at risk. Before deciding how to file, ask these questions. Is there a registered LLC or legal entity? Do both spouses materially participate? How is ownership structured? Married does not automatically mean Schedule C. Structure matters. Entity choice matters. And filing correctly matters. This is one of the most common filing mistakes I see with married business owners. If this video helped clarify things, make sure to subscribe and share it with another married couple who owns a business together. My name is Noura. I help thriving entrepreneurs stop overpaying in taxes and file correctly. I'll see you next Monday.